why it's so exciting to operate a D2C startup in India right now is because it's a big market and it's also a growing market. Internet penetration is increasing, and especially millennials and Generation Z, their buying behaviors are slightly different from people in their 40s and 50s. They place a lot of loyalty on the brand. They want sustainable green products. So they are likely to stick to a brand if once you have created an identity. A lot of them will stick to it, they'll keep buying it. So the idea of brand loyalty is stronger with them. And right now it's so easy to produce through at least produce and sell and package through internet. So maybe if you wanted to launch a cosmetic product 10 years back, it would have been very difficult in India because we lack the infrastructure. Right now you can easily outsource it, you can produce it, you can package it, you can ship it. So right now, and that's why VCs find it so exciting, because it's easy to create a brand as long as your quality is great. Now, some of you might have heard about Thrasio. It's making waves in India right now. Vivek, can you go to the next slide? I can't switch. Perfect. So as a D2C founder in India right now, you have two options to grow your company, assuming you have reached a certain scale. So first is Thrasio, where you sell your company upfront and work with the buyer to grow your company. Second is you raise venture capital. Now, Thrasio is a US-based startup that acquires independent D2C brands and grows them through more investment through their own team. So this model has become so popular that every country has their own Thrasio companies, and India also has a lot. Some of the biggest ones are Global Bees, Mensa, Goat, Upscalio, 10 Club, who are really interested in acquiring D2C, internet D2C brands, and then scaling up. Vivek, is there any question right now, like anything you would like me to answer? Vivek, I can't hear you. I think you're not audible. Vivek? Some problem at Vivek's end, so I'll just take over. I hope everyone can hear us. In case you can't, please send us a text. We can at least video text. So coming back to the Thrasio model, as I was saying, right now there's an opportunity. Like if you have a D2C startup which is doing reasonably well, you can sell it to a Thrasio company. Now the typical sweet spot is they are looking for companies that have at least $1 million of annual revenue. We'll talk more about it later. I just want to explain how it is different from a venture capital model, and then we can just talk about individual differences. Vivek, can you change the slide? So typically, how a venture capitalist is different from a Thrasio is VCs don't buy you out. They invest in your company, and then the onus is on the founder to grow the company. So say, for example, if you're running a D2C brand and you think there is immense growth potential, you can just make it 10x the size. Venture capital is the way to go. And most Indian VCs and also global VCs have become really interested in D2C brands because of two reasons. D2C brands are highly scalable and there's a massive growth potential. So once you have created a product loyalty, you'll be able to scale it 10x, 20x in a few years. And that's what excites VCs. Whereas, say, if you have a company which is slightly mature, maybe if you're doing a $10 million sale, I think it makes more sense to sell it to a Thrasio competitor because then the upside is limited. So think of Thrasio as like a outright sale and venture capital is more like a partnership. where founders retain a lot of skin in the game. You raise capital, and then the onus is on you as a founder to grow it. Vivek, next slide, please. So there are three things you should absolutely keep in mind if you're considering a sale to a Thrasio clone. First is valuation. So typically, most companies value it on a revenue of and a multiple of EBITDA. It can also be a revenue multiple, but eventually that revenue multiple is also linked to EBITDA. So for higher EBITDA companies, you get a higher revenue multiple. A lower EBITDA company, you get a lower revenue multiple. Now, the advantage right now in India is it's a seller's market. There are a lot of competitors. So then you can find out, you can speak to everyone. Everyone is interested in buying great D2C brands. So then you can just speak to everyone and realize, hey, try to figure out a better deal. So the second thing you should always keep in mind is a structure. So when you're selling your company to a Thrasio startup, you don't get everything upfront. Some companies offer you 60% money upfront, and then you get 20% over next 2 years. Some allow you to keep you some stake over 5 years, 3 years. So there's a lot of structuring involved. So then you have to realize what do you want from the deal? Do you want to make a quick exit? Or do you want to say, hey, I want to stay put for good 4 or 5 years? Because the advantage is, say, if you're in a space where you think, hey, I can just grow it maybe 10x over next 5 years, then it makes sense to go for a longer structure where you say, all right, I'll only take certain money upfront, and then I'll take future capital, the remaining capital over next 3, 4, 5 years. Now the future, whatever money you will get after 2 years is linked to the future revenue. So say if you're able to grow your company by 5x in 3 years, your valuation will increase. The third and the most important thing is the culture. So unlike an outright sale, think of it more like a partnership or like a marriage. You also invested for 3 years, at least 2 or 3 years in your brand. You're only working with these startups. So this is not a real estate transaction where you just sell your company and get out. So you have to work with those guys for 2 or 3 years. So one thing that we realized in one of our recent deals was that it makes a lot of sense for the founder to meet the team, for all the buyers, all the prospective buyers, and then think that, hey, I can grow company more with these guys. So absolute value is of course one thing that you should look at, but also you should also keep the culture in mind of the team whom you'll be working for 2, 3 years. So we just have a question where someone wants to know, like, what timeline, like as a founder, what timeline I should keep in mind. So a typical takes something between 4 to 6 months. So the day you start speaking to a buyer, maybe you take 2 to 3 weeks to speak to everyone. Then you sign up. You just can't engage any other buyer. Then the buyer typically takes 6 to 8 weeks for the diligence. What we have seen is most founders take 3 weeks to give the data, and then the buyers take 5 weeks to do their diligence to exactly figure out what EBITDA we are talking about. Because most founders, especially unless you're running a really big company, don't know your EBITDA. You might think, all right, it's 14% or it's 15%, but you don't really calculate it on a monthly basis. Now, as a buyer, I'll give you maybe say an 8x EBITDA multiple or 6x EBITDA multiple. I'll hire an auditor. Like what was the exact EBITDA for past 12 months? So typically these guys will hire a PwC or KPMG. So process is quite transparent, but you might think my EBITDA is say 17%, while in diligence it comes out to be 14%. So your valuation will come down a bit. Now, another question is Thrasio model feasible for any brand which is like under 1 million revenue? So under 1 million is slightly smaller. So there are some companies who want to acquire a brand for 3-4 crores, annual revenue of 3-4 crore. But then for you as a founder, the upside is not huge, because say if your revenue is $500,000, the best valuation you can expect would be maybe $600,000 or $700,000. So there's not a big upside. Whereas say at a $4-5 million, you have already put in 3-4 years of your time, then you can get a substantial money, which is quite decent in this country. A brief at the start of the presentation. So there are three reasons. One is VCs love companies that are highly scalable. That's why you'll see a lot of tech companies, VCs investing in tech companies, because you can just grow 10x in 2 years or 20x in 5 years. While a traditional business, that kind of growth is difficult. So that is one advantage why VCs are so much interested in scale in D2C companies. Second is the margins are typically higher. So you need to spend a lot of money to acquire a customer, but once you have acquired a customer, since you don't go out through an intermediary, there are no sales and distribution cost. You're just selling directly to customer. The margins are quite high. So these acquisitions pay off well in the future once you become quite big. And the biggest reason is as a good brand, you can build a moat. So as a VC, I'm interested in putting money into something where I know all of a sudden a new company just can't come and take out my market share. Now, what has happened in India with the new age customers, millennials and Generation Z is, as I told you earlier, they're very loyal. So once they relate to your brand, once they relate to your core belief, they're going to stick with you. So that's a big advantage as a VC because my revenue won't come down once I've taken it to say a few $1,000,000. It's highly unlikely that a new brand will come in and just cut cost and take away my customers. So these three things make D2C brands really attractive to VCs. And that's why you'll see there is so much interest, venture capital interest. Vivek, you want to take it to the next slide? So, but there are also some major differences in Thrasio versus venture capital. Now, Thrasio, if you're burning cash, no one is going to buy you. So you need to have a positive EBITDA to sell it to the Thrasio buyer. Because these guys are not exactly venture capitalists, so they are not going to invest money to build a brand that are already built and then use working capital or more marketing dollars to grow them. Whereas venture capitalists are totally fine with early stage startup where your revenue is less than $500,000 and when you're burning cash because the idea is to grow the brand quickly, take revenue 5x, 10x as soon as possible. Now, the second biggest difference is the valuation. Since Thrasio acquires slightly mature brands, and also as a founder, your skin in the game is quite low, you just get a lower valuation. $5 million brand, now $5 million revenue, you can get $6-7 billion as a valuation, $8 million. And most of the money you get it upfront. While venture capitalist is quite different. Now, as a VC, if I invest $1 million in your company, as a founder, you'll get nothing. That money stays in the company to grow the brand. So that's why VCs put higher valuation because the risk is also high. Since as a founder, you're not getting anything, you still have to grow the brand, stay with the company for good 5-6 years. Now, another question is how much is a healthy EBITDA? So, especially on the Thrasio acquisition, your EBITDA should be at least 10%. So anything above 10 is fine. But for most buyers, the sweet spot is between 15 to 25%. So we haven't seen any brand with more than 25% EBITDA. We have seen some founders who say, hey, our EBITDA is 27, 28%. But typically in a diligence, when you have auditors involved, there are a lot of costs that we don't account as a founder. So eventually it comes down a bit. So we have a company with more than 25% EBITDA and less than 10, the buyers won't be interested. So you should be targeting something like 15 is a good sweet spot, 15 to 20%. You will have a lot of buyers. Now there is another question. Are vertical integrated companies better suited for Thrasio buyouts? Say if you have a manufacturing setup, Thrasio is not paying for a manufacturing facility. They're just acquiring a brand. So we were just working on a deal where the founder gets to keep the manufacturing with himself. So because the Thrasio, their objective is to buy a brand which has tremendous loyalty, good traction, and grow it. They're not really manufacturers. So you might have a brand where you say, hey, I also manufacture and I sell it. So when the actual acquisition will happen, they'll pay you a multiple of your revenue or your EBITDA, and you'll get to keep the manufacturing facility. What you'll sell is the brand right. So you can manufacture pretty much what you want, but then you can't own a brand in a similar space for next 5 years. Now, this is what we just discussed, that why is VC valuation higher? Because as a founder, you have substantial skin in the game. Like it's much more riskier. Even if you raise $4-5 million, there's a chance that your company will go bust. You might not be able to scale as much as you want. Whereas in a Thrasio acquisition, you just get 60 or 70% upfront. And then typically these companies usually don't go bust because they are profitable brands. They also not the kind of brands that will grow 10x in 2 years, but they'll grow 2-3x in 2 years. So the upside is also limited, but the risk is minimal. You are just getting a lot of money upfront and then you're getting everything in 2 years. Whereas on the VC side, as a founder, you might take good 5-6 years for an exit. Next slide, Vivek. Vivek. So this is just we discussed right now. So on a Thrasio model, risk is lower as well as return is lower. Whereas in a VC raise, risk is also higher, but return is also substantially higher. Now the question is, what should you do? So venture capital is not meant for everyone. Why? Because it's highly competitive. So you might say there are maybe 50 startups, like what we have seen in our experiences. Not every D2C startup is able to raise venture capital. Whereas on a Thrasio acquisition, as long as you have a certain scale, it could be $1 million revenue and 10% EBITDA, you will be able to sell it. Because right now there's a lot of capital in the market and there are few such brands. Whereas on the venture capital side, I can have an idea or I can have a small brand with 100, 200K revenue. So it's quite competitive to raise venture capital. Now, what should you choose? Next slide, Vivek. So it depends, how do you see your business? So as a founder, if you think, hey, with external capital, I can grow the business 10x, there's still a lot of market untapped, then our suggestion to our clients is try to raise venture capital, because then the upside is massive. There's still a lot of risk involved, but then if you're confident that, hey, there's still a lot of growth left, you can make it really big. Whereas what you have realized is that I can't grow it 5x now. I've already reached a $5 million revenue. This is a niche category. This can't go to $100 million category. Then it makes sense to sell it to a Thrasio competitor, Thrasio company, and then just whatever, then it's up to you. Like we have seen most founders, since it's still quite new in India, we don't know what these founders will do, but most plan to start a new brand, because once they have realized how to build an internet brand, they would like to sell the brand, work 2 years and handing over the brand to the buyer, and then start something new. So this is again like grow versus sell dilemma. What should you do? Our advice is under 5 million revenue, raise venture capital and grow. Why? Because a $2-3 million revenue brand, it's easy to take it to a $10-15 million. While if you are like a $10 million scale, it's slightly difficult to make it to $50 million. There are not a lot of consumer D2C brands that are doing $50-60 million revenue. Now we hear from a lot of founders like, hey, but right now is the right time to sell. My revenue is only 1 million. I can grow it to 5 million, but will I be able to sell it after 2 years? So what we have seen it and what's happening all over the world is these acquisitions are here to stay. Now there's so much global venture capital. There's like so much surplus capital in the world that they're looking for good opportunities. So as a founder, I won't be worried that if I can't sell it right now, this wave will pass. No, my sense is this wave is here to stay for at least 3, 4 years. So it would make sense that you can just grow it, just raise venture capital, do a small round, grow the brand, and sell it after a couple of years. Now we are just running short of time, so I just thought maybe you can just email us all your questions, and then we we would like try to answer as much as possible. One thing before we wrap up is, even as a founder, either you want to raise your venture capital or you want to sell it, you should get a diligence done, like hire a smart auditor, because what we have seen is even the smartest founders don't know what their monthly EBITDA is, how it has changed over the past few years, or at least even the past few months. So you might say my EBITDA is 14% for April or 16% for June, but most often that number is wrong. So what we realized in one of our brand sales was a founder we assisted. The founder took 3, 4 weeks to negotiate with all the buyers. Now he could have used that time to establish his monthly EBITDA set with his auditor. Because once you exactly know what your EBITDA is, then you can negotiate better. You can tell us, all right, my EBITDA is 16%. This is the value I can expect, say a 6x EBITDA multiple, 8x. Now, if it comes down at 10% in diligence, it might not be so attractive to sell your brand then. It might be more attractive to grow your brand. So what our advice is, even if you don't want to sell it or you don't want to raise venture capital, still makes sense to maintain a detailed MIS, start doing it right away. It will take, you'll have to spend some time, but you'll make it like it will really strengthen your hand. You'll be able to negotiate better, both with a VC as well as with a buyer.